Okay guys, welcome to the 6th installment of the ICT Sniper series, and we're going to be looking at a few things in this topic. This is probably going to be one of the most brief out of the series, but I promise you we're going to have a gangbusters of the last two episodes in this series. This one's kind of important because it really focuses on the risk aspect of trading and the element of reducing risk and controlling risk. While we essentially can't remove entirely every aspect of the risk, we can do our best to try to control it as best we can and or mitigate the effects of risk over a period of time. In this episode, we're going to obviously look at a review of the previous episode's assignment, projecting swing targets. And we're going to be looking at some examples and projections in illustrated form. And we're going to be giving a Euro USD bullish example, a Euro USD bearish example, controlling risk, and effective stop loss placement. Okay, we're going to be looking at the concept of limiting your trading to a defined risk percent of equity. What is the industry standard? What is ideal for most speculators? And when you're hot, how high is high? And we're going to be looking at stop loss concepts and how many pips per risk per trade. I get this a lot in email. And how to remove risk in open positions, trailing your stop loss, and watching your six. Okay, we're going to be looking at risk reduction versus bailout. And we'll have another homework assignment. We're going to be studying the average number of pips intraday. Okay folks, real quick, just give you a quick example for a bullish upside objective swing projection. We have this high here, down to this low. You see how we have this price swing here? Now it's comprised of smaller price swings. This is a daily chart, but the overall swing is from this high down to this low. And the 200 extension, which we didn't give the actual level on our fib in this series, but we did talk about the 200 being pretty much the maximum level that we like to see, which is basically a measured move type of price phenomenon from this high to this low. That same range is the same thing from that high up to this fib level. You can see it pretty much nailed the high. If we break this down, we can go down into a 4-hour chart. Okay, and what we're going to look at here is that market moving lower here. We have this swing up. Okay, so there's going to be a fulcrum point right here. Okay, and what I'm going to do, I'm going to give you the fib projection right here and the 200 levels down here. Now we did wick through it a couple times, getting a small little reaction here now, but this is the overall price swing, and it broke down. Here is the 127 easily reached, 162 easily reached, and then went down below these market structure lows over here. Okay, so you can see the complete fruition of the market maker sell model here. We have the consolidation, the break out of it, the first little pause in here, then rally up, failure swing, and then subsequent optimal trade entries, which we called this in advance right here on Twitter, and slammed it down. Okay, we were calling in advance this level here and this level
in here as well. You can find that on Twitter. Again, it's all time and date stamped. Now, you could take this even further and go down to a 15-minute time frame. Okay, and just simply looking at the 5th of November, you can see that we have this swing here. When it breaks this low here, okay, it's going to be a fulcrum point right there. So anything moving down in price will most likely be a fib level for downside objectives. Okay, here's the 127 extension from this low to high. It's 127 and 162, and then 200 extension here. And as a result, price is up here. Okay, you can see, let's take these other fibs off, starting to blend. While price is moving lower, you can see this rally up. Once it takes the low that we're anchoring the fib from out, okay, this being the fulcrum point, you have your 127, your 162, and just fell short of the 200 extension here. And again, that's the reason why I don't really marry the idea that the 200 is always going to get hit. I really like the 162 and I like the 127, obviously, but we'll break it down further in the next video as to the other targets and other means of looking for additional targets and multiple targeting, and that'll be in part 7. And I know we've been dealing, or at least attempting to move exclusively with the Euro USD pair for this teaching series, but just for the sake of argument, let's take a look at 2 other pairs. We'll look at the Canadian dollar. Okay, here's the Canadian dollar, and let's go down to a hourly chart. Okay, and let's zoom out just a little bit. All right, we have the market trading lower into a level of support, which I'm not going to outline here, but if you go out to your higher time frames, you can find the order block where this reacted to. But if you use this high here, market structure shifts right there. So this becomes a fulcrum point right there. Trades up, comes right back down, finds support at that same level. But if you pull a fib from that point down to the lowest low, okay, you have your 127 easily reached, 162 easily reached, and then 200 very easily reached. Okay, if you take your fib level, okay, here's the 50% level, or fulcrum, or equilibrium. Okay, and you can see the 100 level here, which is basically what you're getting with a 200% fib level. Okay, but I'm trying to teach you everything is based on like a 50% basis. Okay, so it's like a 50% rule. If it moves down this many pips, once it breaks that high, it should at least try to move that same number of pips up. Okay, and when it does that, we have what is referred to as market symmetry, and trading patterns and setups become very, very clean and very high probability when that occurs. Okay, since we've taken out this this high rather here, okay, one could do this on the high down to this low. You have 127 up here and your 162 up here, which incidentally is an old high back here. If you zoom out, you can see that is the case over here. And again, that's assuming we do have traction and continue to move higher. The next pair we're going to look at is the British Pound USD. And here you go, here's a nice order block and a reaction of it. This was put on the charts in advance, and you can see the reaction of price afterwards. But we're going to look at taking this fib off, and we'll take the rectangle off because zoom out a little bit. Okay, Now we have the same scenario here. We have price moving down, nice price leg here, comes and rejects this low. Okay, there's several of them in here that you can use. Obviously we'll use this one here, this swing. When this high here we're anchoring gets broke to the upside, you'll see the Fibonacci levels come into play. Here's the 127, easily reached, 162, and then 200 extension here. Okay, going back to this higher market structure high here, using that same reference low. And this is how you trade within a market's structure. So once this high is violated right here, we would be looking for upside objectives. 127 easily reached, 162 easily reached, 200 level easily reached. Okay, let's go out to an hourly chart, same pair. Okay, let's scroll over here a little bit, and now as soon as I can get this fib, okay, we'll use this high here, and price just reached the 127 extension here. Any upside would be 162, and if you use this high here, all we're doing is moving out to the next successive market high. So each one of these is a price swing. You have a high down to that low, you have a high down to that same low. Okay, these are all reference points for reactions. Okay, you have 127 now here, and then you have this one here, and there's a lot of liquidity sitting right above that. These are all hourly candles unable to make a higher high in here, and we're about to blow that out right now while I'm recording. And then the 127 resides up there. Now, with these levels in mind, okay, we're going to highlight that 162, the 127, and now what I'm going to do is I'm going to reference this larger price swing, because remember, markets are fractal. Okay, you have the high down to the lowest low. You see what resides over here? Here's the 62%, sweet spot, and 79% retracement level. There's a high probability that a cable will reach up to these levels in here. Okay, and if you just note that right in there. Okay, and that would be a good area to hunt some scenarios. We have an order block in here that could be a factor if we get through this area in here, because this is a nice support level, never been retested. So we may come up to that 62% retracement level around that 161.25 level or 161.30. So we could tap up into that. But you know, I'm kind of blending a couple things here with the Fibonacci price projections. But hopefully you got a few examples here. You can see how useful they are. And from the time we did our recording, the last time, let's just give a sell scenario. We have this price rally up. When this low is violated, as it is here, this low becomes a fulcrum point, and any price action from that point, from that low up here, once it's violated lower, here's the 127 easily met, 162 easily met, 200% extension easily met. Okay, and you can probably see Key will actually do that while I'm recording this. I'm kind of tempted really to keep it on just to show you what it does, but anyway, you just watch it on your charts in retrospect. But you can see, obviously, you know, the fibs, when you have it in the right direction, they're very strong in terms of looking for high level upside and downside objectives. We have this low made here from this high. I'll just give you a bullish scenario on the cable. I'm dragging it over so you can see the levels in reaction to the high. So his high down to that low, 127 easily met, 162 easily met, 200 extension, bang. Swept through it just a few times in here. Again, this is why we do not try to get all that. We don't care that it does this, okay? If one is able to just get a piece, say you got it in here, and up to the 162, that's 210 pips. Nothing wrong with that. Who cares about the remaining portion, okay? Let the cubs eat. Alright, so hopefully that's been insightful to you guys.
Okay, guys, we're going to be looking at how stop loss placement is utilized in your trading. We're going to be looking at how risk percentage is an important factor to your trading. But before we get into all that, we're going to be looking at how, obviously, looking at a bullish scenario here, everything we talk about in this example can be flipped 180 degrees, okay, and you'll see the opposite for selling scenarios, okay. So every rule you see here, just reverse it, and you'll get the understanding for selling short in the market and then how to control your stops and such. Okay, we're going to assume that we have a key level and or institutional order block identified on our charts, and again we're going to be looking at a daily chart for this example. And the market has been showing in this crude example in hypothetical terms that price would be more or less trading down to our line here of anticipation, and as price starts to move aggressively down to that level, we would be, hopefully, if we're not in front of our charts, we would have our platform for trading alert us to the fact that price is getting to our specific higher time frame price level. Now as price trades to that level, again, because we are flexible, we are not limiting our perspective simply to one line, therefore it has to stop on that line, turn on a dime. Okay, there is a gray area in trading that we identified earlier in this series, and we've come to, hopefully by now, terms with the fact that we can't get perfection in the marketplace in terms of turning points. Okay, we have rough ideas where price should turn, but even the highest level key levels and support levels and institutional order blocks have a little bit of gray areas where it could deviate just a little bit. But more specifically, we're going to be highlighting obviously all of our trades around key levels, round numbers, institutional levels, and a confluence of support and resistance factors with time of day. Okay, so you have time and price theory combined. So as price goes down into this level, that's when we are on the prowl for a buy scenario. Okay, we're trying to buy during that event. We don't want to be buying after the move has already turned around and everybody sees that it's a swing low and it's moved up for 3 or 4 days. We want to be buying in a suppressed market environment. We want to be looking at bargain prices. Okay, we don't want to be buying at retail prices. We want to be buying wholesales. Okay, so assuming that we use the information that we talked about earlier in this series in terms of framing a reactionary level to a trade, we're going to assume that we anticipated at that key level that the market had turned, okay, and maybe retested and gave us an optimal trade entry on a lower time frame. Now we're going to assume for this example that we were fortunate enough to catch a long position at that key level, okay, and it's not important that we have a specific price level in this example, because really what we're going to be looking at is how traders are always, in my experience, okay, even when I was an earlier developing trader, I felt the need to want to exit the trade immediately. As soon as I saw some gains, I had, this overwhelming feeling that I had to hurry up and get out and close the trade. If I was up several $100s, I would, think, wow, this is good. I've taken losses and a series of losses. This feels good, and I just would rather not leave the market with another loss after seeing these gains. When you have a sound entry, many times those are the scariest trades to hold on to, okay? Because the good trades don't spend their time very long at wholesale prices. They immediately start to move to retail level pricing, Okay, in other words, if you're able to catch a very low price point and you're long in the marketplace, you anticipate as a professional trader prices moving rather aggressively away from that level. Okay, and that's what we talked about earlier in our series, that the more conviction that we see behind price moving away from a specific level that we hopefully predetermined in advance, that is what we would anticipate seeing in our trades once we've entered it. We don't want to see the market dragging its heels and lethargically moving around, because um, we're going to be mentioning time stops in this episode too. I'm not going to beat it to death, but I do use a time stop, and I'll explain it as we get to that point. But as the market starts to move in our favor, okay, we would be reaching for our predetermined price points like we discussed in part 5 of this series, where we looked at the fib to give the 127 and 162 extensions as possible upside objectives. Now again, those with the confluence of supporting factors with support resistance, maybe even pivot points, something like an old high or low to frame those upper level objectives, not simply because the fib calls that level. We want to be looking for other things as well. Again, factoring the time and day of week phenomenon as well. Now again, getting back to this crude example as we have here, when the market is now moving away from your entry point, okay, one of the closest things to insanity is when you have this environment, unfolding for you profitably. Okay, it's amazing how traders, and I know this firsthand. Okay, when I first began trading, I would hold a losing trade forever and forever and forever. And I'm sure you probably felt that same thing too when you're trading, because you really want to see it turn around. Hope springs eternal. Not in Forex, not in speculation, and certainly not in trading. Okay, so the market doesn't have to go back to your price point. Okay, if you look at the Dow, just look at anything from 7 months ago. It's been a while since it's been back to those levels. Okay, so if you've been waiting for the market to get back to those levels, man, you're just going to get grinded to pieces. Okay, so don't do that. Have a predetermined area where you would expect to cut your losses short. Okay, what is the industry standard for risk? Okay, you commonly hear, and I hear myself say it all the time in these videos, because I want to more or less uh, segue into the majority of everyone's expectations and analysis. But really, what I try to do is say, okay, look, everybody says 2% of your equity per trade. Okay, and if you're a really, really solid trader, there's nothing wrong with that. Okay, now I suggest that traders should work within the realm of 1% of their equity per trade. Now the reason for that is, assuming that you had a $10,000 trading account and you were risking 1%, how much money would be at risk per trade? $100. Against the standard 2%, which would be $200 per trade total risk. And the way you determine your pip size is you take that $200, if it's 2% or 1% at $100 total risk of, assuming that you have a $10,000 trading account. If it's a $1,000 trading account, then it would be a $10 for 1% or $20 for 2% total equity risk per trade. Whatever that dollar amount is percentage wise, whether it be 1% or 2%, ideally 1% or less. Okay, and then I know that probably sounds like, well, wait a minute, I can't make a lot of money with that. That's right, because if you're just starting out, you need to forget about making a whole lot of money, because there's a whole lot of learning to do. So, assuming that you did have a $10,000 account, okay, and you've worked with smaller accounts, you've proven to yourself that you could be disciplined, you have a track record of being consistent, you control your risk, you limit your losses, you let your profits run, and your targets started getting hit on a more consistent basis, you have a risk of $100 per trade, which is 1% of $10,000. You take that $100 and you divide that by the total pips, okay, needed to justify your trade. Okay, and with the assumption that this is a daily chart here, it could be very easily in the realm of 100 pips or more.
okay, which would put you at very, very low uh, leverage for the trade, which really, in a way, isn't that bad. But I know a lot of you folks watching this really want to have a little bit more bang for your buck. So, using the concepts we used in the earlier videos, if you move down to a lower time frame, you can reduce your reduce your risk to less than 50 pips. Anywhere between 30, 40 is about ideal, in my opinion, because it allows the developing trader to have a little bit of a fudge factor where they're not expected to be so precise with their stops, okay, and gives you a little bit of flexibility, because I know inherently that traders will rush the entry, or they will look for confirmation in their eyes, quote unquote confirmation, by letting the trade start to move a little bit in their favor and then chase it, but very close to their entry price, but still within the risk parameters that's permitted by their method or this concept. So if you had that in mind, okay, you could have basically $3.30 roughly per pip if you're trading a $10,000 account with 1% risk using a 30 pip stop. Okay. Um, the reason why the industry standard is 2%, sometimes you hear in certain circles, you could risk more than 2%, okay, because that's what the real traders and the real professionals are doing. I can tell you the real professional traders aren't doing that, okay? They're not risking a whole lot of their money. Um, for disclosure's sake, I do risk as much as 3.5%. That means I'm trading with the higher time frame, weekly, daily, and 4 hour, all in the same direction. Everything's lined up with those three time frames, and I have a weekly bias that's in the same direction, and that will allow me, based on my abilities and experience trading, I will risk up to, and it's not a whole lot that it happens, but up to 3.5% of my equity for one trade. Typically, it'll be anywhere between 1 and 1.5%, because the time frames aren't always lined up like that. You'll have a counter trend move going against one of the primary higher time frame uh, time zone, not time zones, but time frame, weekly, daily, and 4 hour. So if I'm trading against that on a lower time frame, obviously 1.5% is a maximum, um, for sure. If I'm trading with a daily and 4 hour in the same direction, I can be as much as 2% risk. Now, how high is high? Okay, I think if anybody's risking more than obviously 3%, unless you're really, really proficient, you really know what you're doing, and you know how to turn your equity losing string around, because it's not just one trade that you lose on, guys. Sometimes you get a couple of them in a row, and even the best traders out there will suffer that and have suffered that regardless of what they tell you. So assuming that's the case for you and you're human like everyone else, you have to have an idea of how to control that. And the best way to do it is reducing your overall exposure as you take losses. Okay? And I'll give you an example. Let's assume for a moment you settled in on the idea of taking 2% per trade. If you take a loss, you've lost 2% of your equity. Okay, now if you risk 2% on the next trade again, thinking that, well, if I make the same amount of money I lost on my previous trade, I'll get back to even. That's where the cycle begins. Okay, you want to get back to that previous equity level, that milestone, that marker, okay, that comfort zone, internally as a trader, and that's not a good game to play. Okay, and what happens is you're actually inviting more emotional response and triggers into your trading than you should have. Okay, and by systematically and methodically reducing your risk in half, okay, for instance, if you took a loss at 2%, you only risk 1% on the next trade. It may take you 2 or 3 trades to get back to that previous mile marker, but guess what it's doing? It's removing the rush factor to get back to that point, and it's honing your patience with the added benefit of lowering your overall exposure to the marketplace. Now think about it. You're in a losing
environment where you've had suffered a loss, for a developing trader, that is very, very hard to swallow, regardless if it's a demo account or not, because you are still working within the realm of psychological and emotional barriers that you just simply don't understand until you've traded through it or you've experienced it and said, this isn't for me, and I, leave the market altogether. And there's nothing wrong with that because trading's not for everyone. And it would be irresponsible of me as a mentor to not at least suggest that to some of you, because if you can't wrap your mind around doing this and assuming some level of risk, this is absolutely not your cup of tea. Okay, and that's one thing you can guarantee coming from me as the gospel. Not everyone on the planet is meant to do this, and it takes a certain level of commitment and tenacity to stick within a realm of rules. And humans are typically very good rule breakers. We don't like to, follow the rules. And just think about it. If you walk down the street in a well-groomed neighborhood and you see a sign that says "Don't step on the grass," what's the first thing you want to do? Step on the grass. Just look at a kid. That's what they're gonna do. I made so many jokes as my children were growing up that they were like heat-sinking missiles. Okay, we would get new carpet in the home, and my wife or a guest would come over, and they'd invariably have their drink with them in our dining area or our living room or family room, and our children would come in, and being kids, they would roughhouse just for a second, and they won't fall away from the tables or fall away from the only person in the room with the drink. They fall and land either on the drink or into the person, and it drops and goes all over the white carpet. Or at the time, we had a very light colored tan carpet, and the drink caused havoc on it. We had to get it cleaned. So those things are going to happen. So you have to prepare for it. So you're going to have that in your trading with wanting to do something you shouldn't do, and you're going to have that Murphy's Law scenario as well. What can go wrong probably will go wrong. Okay, so you have to have that shield up in your defense, and that's only going to come in the form of you controlling your equity. Okay, and if you take a loss, don't be afraid to cut your risk on the next trade. And if you have to do that continuously down to a 0.5% total risk of your equity, that's fine. There's nothing wrong with that. Okay, remove from your mind right now that you want to make millions of dollars right now. Okay, because that is the wrong perspective going in. There's nothing wrong with having goals of doing that, but initially you have to take the bite first. Okay, and then chew the elephant one bite at a time. You just can't go in there and try to swallow it all at once because you'll choke. So with that in mind, okay, once these moves start to move in your favor, okay, you obviously want to be able to remove the risk, okay, and at least during the move, trading in your favor, you want to be removing a little bit of the risk methodically until you get to the point where you have zero risk or quote unquote no risk exposure. Okay, obviously anything can happen in the marketplace. Something can happen. The markets could gap because of a terrorist event or something unexpected in the Fed or whatever, and there'll be a massive movement, and your stop loss experiences a slippage. These are all things we understood when we signed up for this game. So, bottom line is it can happen. Prepare yourself for it because you're going to take losses, and if you trade of any length of time, you're going to have a lot of losses. Okay, and there's certainly nothing wrong with it. It's a cost of doing business. Yeah, every successful business out there takes a loss of some sort, but you don't see those businesses, collectively going out of business. Okay, they trim, they put things, up for sale just to get rid of inventories ain't moving real fast, and they bring in the better movers. Okay, and that's what you do for your trading. If your trades aren't really panning out, cut the losses short. Okay, or the mules that aren't really moving, just get rid of them, and then keep your powder dry, waiting for the next setup. If you do that, okay, if you do that, I think you'll see a more streamlined increase in your equity, and I think you'll remove a lot of that whipsaw you possibly have been seeing in your equity curve on your beginning balance and where you're at now. Time stops. Okay, I have a premise that if the move doesn't start, if I'm trading off of a daily time frame,
and it really doesn't start to move in my favor after 3 days, okay, I'm aggressively either removing the risk if possible, or I'm taking half the position off, okay, and I'm watching my six. The military has an expression that wherever you're pointing your rifle, okay, or a firearm in front of you, that's 12 o'clock. Your six is behind you, okay, or watch your ass. Okay, what you're looking at in the marketplace when you see a trade that isn't moving in your favor right away, and I think 3 days is enough time. If it's still consolidating or still hem hawing around, not really moving, I'm looking to either take half the position off and move my remaining position to either a break even, or aggressively take it to half the initial risk or even a quarter of the initial risk. Okay, so I may like the overall setup that still might be there, but it could be iffy. Just watch your six, take your position and cut it in half, remove aggressively half the initial risk if possible, or at least reduce it down to a quarter of the initial risk on the remaining half positions you leave on, or simply bail out, just collapse the trade. Okay, and if you're underwater just by a few pips, so what? If you're risking 30 and you're down 19, and you just see that it's really not moving, and you're going into a Friday perhaps, that's the worst scenario for me. I will collapse it and just take whatever that is as a modest loss. No, you didn't get stopped out. No, you didn't get any of your targets, but you're getting rid of the dog, or you know, getting rid of the slow moving inventory, and you want to get another, hopefully more opportune setup with your equity behind it, so that way you can recoup that. And if you do that, systematically, I find that all of those little tiny scratches immediately get smoothed out quickly with moving my equity into a better, more sound setup. So time stops is something that to me, I think is beneficial. There's a little bit of an art to it, but I break it down like this: if it's going to be a trade that's based off of a daily setup, I give it about 3 days, and if I'm trading off of a 4 hour, I'm really giving it about 1 day. And a 1 hour chart is I'm giving it 2 sessions tops. Okay, ideally either the London or New York session. If it hasn't moved by then, and it's on an hourly basis, I'm really looking to reduce the risk and or collapse it. And anything less than that, I really don't have a time stop for on outside of the intraday time frames of London to London close, London open to London close rather. So assuming obviously that we have our scenario that unfolded here hypothetically, and we suggesting that we bought long in this market, whatever that market may be, we'll just say this is the euro, and the market starts to move in our favor. So we have some paper profits right now. Our stops are still at an initial 30%. I'm sorry, 30 pips, and we have not yet made our first profit objective. So what do? Well, you want to be systematically reducing your risk. If you started with a 30 pip stop, move it down to only 20 pips. And as the market moves and takes out your first target, take your stop loss and move it to only 10% risk. Okay? And as it moves and starts approaching your second target, that's when you go to break even. Okay? You do not rush your stop trailing. Okay, this is one of the biggest mistakes traders make. Because of the natural volatility in the Forex market, it's so easy for just common volatility, nothing behind it, no market maker sneaking to get you. It's normal volatility, okay, illiquid volatility, okay, where markets come down, fills market inefficiencies, and they take the market down to a specific level to gather up any orders and then go the other way. Okay, we're not talking about stop rates, we're just looking for common little intraday retracements. Okay, if you rapidly move your stop loss up behind market pricing, you're asking to get taken out of the trade before it comes to fruition. Okay, once you have the setup, what you're doing is you're anticipating the market to start to move in your favor. But this is a gray area because you don't know for sure it's going to do that. Okay, yes, the market could potentially continue to move in your favor, or it could turn around and stop you out, or it could stay in this small little consolidation area for days and make no money for you but a small paper profit. But you'll hold on to it thinking it's going to go to the moon. I know you because everybody's the same way when they're developing. We all think the market's going to go like a rocket, either up or crash down, okay, to the ground like a meteor just plummeting to the earth. They don't move in straight lines, guys. Okay, so while we would anticipate, okay, higher prices and we expect that, hopefully, okay, hopefully that we see that. Again, keeping in mind that's a gray area. We're expecting those price levels to be reached on the upper side, but they're not promised. Okay, so inside of that gray area of anticipation, we have an expected outcome in price action, but we can effectively manage our stops within that move. Okay, and there's a way that I do it, but once you have your setup, the way I manage my stop losses is I use a 15-minute time frame. Okay, and the 15-minute, because this setup in this whole series has been really developed on finding one solid weekly setup where you can take a really good setup for a weekly opportunity to make a consistent realm of pips, anywhere between 30 to 60 pips. I think is an ideal scenario for someone to try to carve out a consistent living. And if you are consistently doing that, there's certainly no reason why you can't take a very handsome living out of this marketplace and not trade a whole lot of pairs either. So why do I use the 15-minute time frame? Well, there is very clear discernible dealing ranges and support and resistance levels, okay, that are clearly discernible on that time frame, and it allows you to look at a whole weekly perspective from Sunday to Friday's close. Perfect example, pick any pair of your choosing. Load up a 15-minute chart, condense your chart so it shows Sunday to Friday's close, and you'll see how that time frame gives you all of the session highs and lows. It even gives you a very clear snapshot of all of the volatility for those particular sessions: London, New York, Asia. And you can actually see where the range highs and lows are very clearly. And then you can see the small little quiet points in the marketplace in between those sessions. Also, the notion of finding the weekly high by Tuesday or no later than Wednesday's London Open, having that in mind, okay, expecting a specific outcome based on a higher time frame directional premise, with that assumption here being bullish, we would be looking for the Monday, Tuesday, or Wednesday London Open session low, making it for the weekly low by that time. Okay, in other words, by Wednesday's London Open at the very latest. Typically, you got about a 70% likelihood that the low is usually formed by Tuesday's London Open. Just reverse that obviously for bearish conditions, but you know, the way I manage my stops, once they've moved to break even, I use a 15-minute time frame, and I find the most recent swing low on a 15-minute basis. I note that one, and then I go back to the previous swing low prior to that one. That swing low is where I take my stop, and I just place it just on, in bullish environments, just beneath it by 10 to 15 pips. Okay, 10 to 15 pips below the second most recent swing low on a 15-minute time frame, and I trail the market like that. I'm giving my market a little bit of opportunity, okay, to retrace, but not come all the way back down. If it comes back down that far, I'm accepting the fact that the move is probably done. I missed the ideal opportunity to get out, or the market's reversed and my analysis was wrong, and there's certainly nothing wrong with admitting that. But by using the previous two swing lows, okay, what it's doing is it's allowing successive 79% retracement levels. Okay, and when we look at an examples, you'll see what I mean by that. But it builds in a allowance for market structure to continue to make higher highs and higher lows. Okay, plus it keeps it away from just pure static volatility coming down and tagging you. Okay, that's the reason why you want to be taking some profits, okay, initially. Okay, it may be 20 pips, it may be 30 pips. You may be getting one for one and then let the remaining portion of your trade unwind, okay, and then reach for higher objectives. There's nothing wrong with that. But there's going to be a camp out there that listens to this and says, well, you're risking 30 pips, but then when you cut the position in half at 20 or 30 pips, you're really not making, any headway with doing that. Well, I beg to differ. Okay, if you have consistency on your side, you are shielding yourself from the inevitable market turnaround while you're in the trade where it does have a small profit. Okay, and there's nothing guaranteeing it's going to even get to your first target objective or second or move in your favor at all. Okay, that camp that believes that taking some partial profits has a fixation to thinking that they're always going to be right. So therefore, their trade should hold on to the maximum lots that were assumed at the beginning of the trade for the full duration of the trade, with the expectation of making maximum profit. My goal as a professional trader, and it should be yours as well, your goal is to have the maximum protection from losing your money, because the likelihood of you doing that is almost guaranteed versus the likelihood of you making money consistently. Okay? Think about that for a moment. If you didn't listen to it closely, rewind this video for a couple minutes, and then go back and listen to that part again, because it is worth its weight in gold. It's so easy for us to think that we're going to make more money if we hold more, reach for higher price objectives or lower price objectives if we're short. There's no guarantee it's getting there. No guarantee. And there's been so many times where I've been so close to the actual highs and lows of the particular market I was trading. Okay, and I'm talking weekly highs where the market turned around and then went months the other direction. Okay, I have been so close where I've just been a piece of a pip, not even a full pip, and I didn't get my exit. Okay, and to me, I hate that feeling. A lot of folks would say, "Man, that's cool. That's crazy accuracy." Yeah, but I didn't get out of that point. So how accurate is it? It just because I said it was going to go there, or I had an order to get out, and it only trades a half a pip to that point, and it doesn't activate, the order. That doesn't make me smart. It doesn't make me an excellent trader. It makes me a person that missed that move. Okay, I didn't get my trade off like I wanted to. And initially, as a commodity trader, I would make that mistake, and it would it would get close to my orders. And I'm saying this when I started getting consistent, not when I first started because I wasn't that accurate. I didn't know anything. I was just fine, flying by the seat of my pants. The the notion of holding on to moves to get to the last piece of the pie is, it's a loser's mentality. You don't want to do that. You just need a big portion of the move. And I just think like a lion. To me, I think he's it on the the terrain of the outback, or not the outback. I guess the Africa's plain. I guess that's what I was thinking of. But you, when they eat, okay, they eat a large portion of whatever was taken down by the lioness. Okay, but they're not consuming everything. And notice what a lion does. Okay, he lets the lionesses do the work. They chase down the prey. They take it down. They kill it. Okay, they may be getting a nibble or two. Okay, but he comes over there and says, "Okay, look, it's obvious this thing's dead. I'm not wasting any effort. Okay, I'm gonna go over there and I'm gonna run them off. And I'm gonna eat what I want, and I ain't gonna consume it all. I'll leave a portion for them to eat too." But he's getting the lion's share. Every move has a lion's share. All you need is a portion of that. Are the lionesses starving? No. Are the cubs starving? No. Everybody's going to get their piece of the pie. But you don't have to rush in there trying to get the very, very low and get the very, very high. In other words, you don't need to make the kill and that turns the market around. And you don't have to make the apex, high. Okay, you don't have to find the very lowest point of the low. Okay, you leave a little bit on there. Okay, let those other traders try to chase all that stuff. You don't need that. And the same thing applies and it's applicable to your stops. Give it some room. Don't be afraid to have the market come back against you. And some of the exercises that you need to be doing is have a demo account and put your trades on and let them come all the way down to your stop. Okay, don't think about targets. Just think, okay, I'm going to be buying today at 8 GMT, regardless of wherever the price is. I'm going to put 30 pip stop on, and just watch what price does. Okay, and just assume what you'd be feeling if you were in the marketplace at that time. How the market trades down to your stop, what it does after it hits it, okay? And then start applying it with your tools that we learned in these videos, okay? Applying the price action study, then using a 30 pip stop below the entry point at where you entered at, okay? And watch the market move. Once it takes the first profit target that we could discuss, the 127 extension, or an old high that you pull your fib from, when you see that first target hit, don't move your stop up, okay? Do a couple trades like that. Do about 20 trades or so like that, where you just go to break even once the first target's hit, and then wait for the second target to be fulfilled. Do not move the stop. Either you get the second target or you get stopped out. Do that for 20 trades, okay? And it's obviously easier and faster to do it on an intraday basis, like doing 5-minute and 15-minute setups. Um, but some of you traders can't do that because you have jobs or whatever, but that's fine. But then eventually then graduate to moving your stop loss in the form that we just discussed now by having a 15-minute time frame using the most two recent swing lows for bullish scenarios, 10 to 15 pips below the lowest of the most recent two swing lows. Okay, and obviously just for clarity, for those that are selling short using your demo account, yeah, I gotta put that in there. I'm not trying to tell you to do anything with real money, guys. I'm not licensed to do that. These are just ideas to stimulate you your decision making. The selling scenario, you would just use the 15-minute most recent two swing highs, and the highest of the two, you would use your stop loss 10 to 15 pips above it, and you would trail that accordingly until it hits your ultimate target. That's really the essential, element to having stop loss management. There's nothing, much deeper than that. It's very simple. I try not to complicate it. I used to have all kinds of intricate ways of doing this and doing that, and I found just simply by taking a 15-minute chart and using the most recent swing lows and highs, whatever those two are, whatever the lowest one is, that's where I'm going to have my stop, in relationship to where price is now. Okay, guys, in episode 7, we're going to be looking at selecting multiple targets. We're talking about setting limit orders at logical price levels for exits. And we're going to be talking about the ICT split gains ratio, leaving some for the just in case scenario, principles for multiple time frame trading. And we'll have the foundation to success that will be given to you in blueprint format in the final episode in this series, part 8. And I think you'll have a pretty good idea of what should be done from the beginning to end stages. And I'm using in a flowchart format for the part 8 series, where if a condition is X, then you go to this next condition. Once that condition is met, you go to the next. So I mean, I'm a computer programmer, and I guess anyone that has computer programming experience, would understand that it's the if-then um, you know, scenarios that you learned in computer programming. If you can't really build a mindset of trading after part 8, I'm going to readily admit that I've failed in sharing some insight on how you could become a more consistent trader. I've put a lot of work, and it may seem like there's been a lot of time between these individual videos, but it's actually been a whole lot of work on that last one, because I've tried to give the blanket scenarios for the common setups that we see over and over and over again. That's very generic in the marketplace, and it won't catch every single move, guys, and don't expect that of anything. But I think you'll be pleasantly surprised how many opportunities it will give you, and what to do and why. And once you do it for a few months, you won't need the flow chart format. You'll just simply know, by habit, of what you should be doing next, and what to do, while the setups are, you know, developing. So hopefully this has been insightful to you guys, and until the next time, wish you good luck and good trading.